Yes, good evening once again. Today we are going to we are going to conclude on traditional weighted average cost of capital so that we can do project specific. So we have today's lecture as well as next week to complete cost of capital so that we can move to a brand new topic. It's becoming monotonous. Almost a month now that we have been on the same topic. All right. Okay, then. Yes, we are currently on traditional weighted average cost of capital. We have explained the concept. We have done about 2 illustrations. Let's have one or two more illustrations to complement what we have done so far. All right. Majorly on the day of your exam, if you are going to have question on cost of capital, even though, of course, examiner usually tests what is the most frequent uh, area of work that's usually tested is the project specific. That notwithstanding, traditional work is also very common. All right. But what is important is for you to understand the concept. No matter how big is the question, it's the same principle that you are going to apply. So as we proceed, you are going to see what I'm talking about. So without wasting more time, let's have one more illustration on work before we move to another one in the cost of capital. Okay, let me see. I think we have solved this illustration number 13, equity pool. Yeah, we did. All right. Uh, this illustration number 12. Now, there's a particular question I want us to go through. It's similar to this illustration number 12, but it's more technical. So I want to use it to explain something to you. All right. So let me stop sharing this and just a kind of is similar to this. All right. Let me stop sharing this and share the other one with you. Let's use this. Let's use the example in the golden book to do the explanation. Yes, I want to show you how you are going to calculate cost of redeemable debt when tax is paid 1 year in arrears. All right. I want to use this example to show you, to demonstrate it for you. Now, yes, for a start, I need one of you to do the reading. Somebody should volunteer and read for us.
Courage PLC. Good evening, sir.
Good
Courage
evening.
PLC is a manufacturer of collapsible furniture located in Abakaliki. The company is trying to decide on the cost of capital to use for the evaluation of a prospective investment project. The company has an issued share capital of 500,000 ordinary share of 1 naira each, currently quoted at 1 naira 17 kobo per share cum div. Okay. It has also issued 200,000 naira of 10% debenture, which are redeemable at par in 2 years' time, with a current market value of 105 naira 3 kobo and 100,000 naira of 6% preference share, currently quoted at 40 kobo per share. The preference dividend and ordinary dividend, including debenture interest, are due to be paid. The ordinary share dividend will be 60,000 naira this year, and the directors have publicized their view that earnings and dividend will increase into the indefinite future. The company's current earnings are 500,000 naira, while the capital employed is 5 million naira. The fixed asset and working capital of the company are financed as follows. All figures are assumed correct in the table. The company's tax rate is 40%, payable 1 year in arrears. Required. Advise the management of Courage PLC on the appropriate cost of capital to use for its investment.
Thank you, Minister of Finance. Yes, that is the question. Let me quickly see if I can share the question with you on your group so that we'll be on the same page. I need to switch. I don't want to use the solution in this material to do the explanation. All right. So I want to demonstrate so that you see how I'm picking the numbers and how we are treating it. Let me quickly see if I can share the question with you on your WhatsApp group. Okay. Yes, according to the question, you are required to advise the management of Courage PSC on the appropriate cost of capital to use for his project, for his investment. You can see in this question, examiner did not ask you to calculate weighted average cost of capital, but it's implied in the question. So it's expected that you know the appropriate cost of capital to compute. All right, because I told you that whenever you are given information on capital structure, then and you are asked to calculate cost of capital, you need nobody to tell you that you are supposed to calculate traditional WACC, because from this question you can see information on ordinary share capital, preference share capital, and then debenture. You're also given on the underlying cost of each source of finance, like you are seeing dividend, you are seeing interest in the question. So we are supposed to calculate traditional WACC. So if that is the case, let's take it one by one. Because you have ordinary share capital, preference share capital, as well as debt in the capital structure, that means we are going to complete the 4 steps in calculating traditional weighted average cost of capital. Of course, you know, the first step is to calculate cost of equity. Step 2, we calculate cost of preference share. Step 3, you calculate cost of debt. And step 4, you calculate weighted average cost of capital. That's what we want to do. Quickly, let's go through it together. So I want to calculate cost of equity. How do I calculate cost of equity? Am I using dividend valuation model, or am I expected to use capital Z pricing model or Miller and Modigliani? In this question, we can see information on dividend and share price. That means we want to use dividend valuation model. So if that is the case, I know I'm going to use dividend valuation model, but how would my formula look like? Is there any growth in dividend payment, or dividend is constant? So I can see from this question, the examiner has told us that, okay, in the second paragraph, you have been told that ordinary share dividend will be 60,000 naira this year, and the directors have publicized their view that earnings and dividend will increase into the indefinite future. The company's current earnings are 500,000 naira, while capital employed is 5 million naira. So examiner has given you the information to calculate your growth rate, because I told you there are 2 methods of calculating growth rate. You can either use historical patterns of dividend payment, or you use Gordon growth model. As you can see in this question, the examiner has given you earnings and capital employed, which are the 2 variables that you need to calculate growth rates using Gordon growth model. So without wasting time, let's quickly go through this together. I would love it if we can complete, project specific cost of capital today. So quickly, let's go through this together within the next few minutes. So I want to calculate, number 1, calculating, before that, the name of the company, Courage PLC. So step 1, calculating cost of equity. Okay, so we have identified from the question that we are using dividend valuation model. Why? Because we are given information on dividend and then share price. So in this case, I would then say cost of equity equal to, also, we have identified from the question that dividend as we increase, dividend will increase because we are given information on earnings as well as the capital employed. Therefore, current dividend multiplied by 1 plus the growth rate divided by ex-div share price plus the growth rate, all of this multiplied by 100 over 1. Okay. So if that is the case, KE equal, I need current dividend. Examiner has given us dividend of 60,000 naira from the question. From the second paragraph, we are given dividend of 60,000 naira. I can decide to use par value to calculate my cost of equity. If I like, I can choose to use absolute value. Whichever of the two that I use, I'm going to get the same answer. So let's try it out. So dividend is 60,000 naira. So if I want to use absolute value, I will just say 60,000 multiplied by 1 plus the growth rate. So we need to go and estimate the growth rate. So I will leave a space. This will be for cost of equity, cost of preference share, cost of debt, then WACC. The third page will be for workings. This is exam approach. Working number 1. Let's start from dividend per share. Because the share price given to us, we are told, is cum div. Therefore, we need dividend per share. And you know that dividend per share is calculated as total dividend. Okay, total dividend divided by number of shares, number of ordinary shares. Number of shares. Okay. The dividend given to us is 60,000 naira. That's the total dividend. Number of shares, according to the question, we are told is 500,000. Let me confirm. Yes, 500,000 shares. So here will be 500,000 shares. Therefore, dividend per share will then be equal to 60 divided by 500.
12 kobo.
Pardon?
12 kobo.
12 kobo. Thank you. 0.12 or 12 kobo. All right. So that's it. That's that. Then working number 2. Let's calculate growth rates. So like I said, because the examiner has told you in the question that the directors have publicized their view that earnings and dividend will grow into the indefinite future. And you have been given information on how to calculate your growth rate. That is, you are given information on Gordon growth model. You have earnings, you also have capital employed. So we are using Gordon growth model to calculate the growth rate. So using Gordon growth model, growth rate is calculated as return on capital employed multiplied by retention rate. Okay. Please mute. Please mute. So R is the return on capital employed. The return on capital employed is calculated as earnings divided by capital employed. Okay. Multiplied by 100 over 1. So according to the question, we are given earnings of 500,000 naira. Capital employed is 5 million naira. Multiplied by 100 over 1. So this is 10%. Return on investment is 10%. Then I need to calculate retention rate. B is the retention rate. B equal to retention rate. And retention rate is calculated as earnings minus dividend divided by earnings. multiplied by 100%. So retention, earnings is 500,000. Dividend is 60,000 divided by 500,000 multiplied by 100 over 1. So what do you have here?
92%.
92. You sure?
88%, sir.
88%. 440 divided by 500. That will give you 88%. So retention rate is 88%. Out of the total earnings of 500,000 naira. So 12% is paid out as dividend. Then the remaining 88% is retained in the business for growth and expansion. All right. Therefore, the growth rate is equal to return on capital employed of 10% multiplied by 88%. So this will give us G will be equal to 8.8%, approximately G equal to 9%. All right. So let me know if you have any concern on how we got the growth rate. So with this, we can then proceed. Now, after growth rate, we're also going to need market value of equity from our formula. Okay, let's go and post that one first. So 1 plus 9% will give us 1.09 divided by ex-div share price. Now, because we are using absolute value, instead of ex-div share price, it will be market value of equity. It will be total market value of equity. It's no more share price. All right. So in this case, let's go and work it out. Before we can get the market value, we need to calculate the ex-div share price, because we are told according to the question that the share price, the ordinary share price, which is quoted at 1 naira 17 kobo per share, cum div. So cum div means that the share price included dividend, and we don't use the share price that include dividend. It has to be ex-div share price. So let's convert this to ex-dividend share price. Okay. So the first item, of course, to get your ex-dividend share price, you pick the cum div share price of 1 naira 17 kobo, then you less the current dividend. The current dividend is 12 kobo. Dividend per share is 12 kobo. So the difference is 1 naira 5 kobo. That represents the ex-div share price. Now that we have the ex-div share price, we can then proceed to calculate total market value of equity. Please, if you are using power value, you may not need that. Or again, when we get to use the formula of WACC, we are still going to need the market value. So it's better we just do our working once and for all. Working number 4, I want to calculate market value. Okay, value of equity. Equity value is calculated as number of shares. I gave you 2 different formulas that you can use to calculate market value of equity, depending on the information available. I told you if you are given ordinary shares in the question, then ordinary shares multiplied by ex-div share price will give you market value of equity. But if you are not given ordinary shares, but of course, you must certainly have share capital. Therefore, share capital divided by nominal price multiplied by ex-div share price. But according to this question, we have number of shares. Therefore, market value of equity is number of shares multiplied by number of ordinary shares multiplied by ex-div share price. Okay. So if that is the case, equity value will then be equal to 500,000 shares multiplied by XD share price of 1 naira 5 kobo. That's what we got here. So this will give us 525,000 naira. 525,000 naira. Then quickly, let's calculate all the market values once and for all. According to the capital structure, we also have preference share. What's the market value of preference share? Again, I will go back to the question. Am I given number of preference shares? I'm not given number of preference share. Examiner only give me the share capital. Therefore, to calculate the market value of preference share, I would then say share capital divided by nominal price multiplied by XDIV share price. Okay. Yes, Minister of Finance, go ahead.
How do you mean the examiner did not give us the number of preference share?
We are not given none. Just like you have ordinary share capital of 500, so you have a number of ordinary shares, 500,000 shares. In this question, in the capital structure, you are not given number of preference shares. You are only given share capital.
So what of
6%,
the 100,000?
100,000 is a value. That's the nominal value. It's not shares.
Okay. Thank you, sir.
So P equal to 100,000 naira divided by nominal price is 1 naira. Multiplied by XDIV share price. So you are told that preference dividend has not been paid. Examiner told you that the preference dividend and ordinary dividend, including the debenture interest, are due to be paid soon. So that means the market price of the preference share of 40 kobo per share is cum div share price. That's cum div share price. So we need to convert that cum div to XDIV share price. Okay, so let me go and do the working. That will be working number 5. See the way we are flowing? So one step will lead to another. I want to calculate XDIV, X dividend, share price. Okay, for the preference share. So XDIV share price equal to, you already know, is cum div minus preference dividend. Okay, so the cum div, we are given 40 kobo, 0.40. That's 40 kobo minus preference dividend. And I told you that preference dividend is the nominal rate on the nominal value. The nominal rate of the preference share is 6%. All right, 6% of 1 naira will give us a 6 kobo. So that's 0.06. That is 6% multiplied by 1 naira. Let me put points there. Let me rewrite it. Okay, 6% of 1 naira. So that's how we got that 6 kobo. Therefore, XDIV share price is 34 kobo. All right, so I can then go back here to say 0.34. When you multiply with 100,000 shares. That will give us 34,000 naira. Then finally, we also need to calculate market value of the debenture. So debenture value or debt value, D, equal to nominal value multiplied by X int price divided by 100 naira per unit of the debenture. All right. So D, nominal value of the debenture is how much? That's 200,000 naira. 200,000 naira multiplied by X int price. We are told that debenture interest has not been paid. So that means the market price of the debenture of 105 naira 3 kobo is cum int price. So we need to convert it to X int price. To do that, you are expected to less the coupon rate, the interest rate of 10% from the 105.3. So working number 6. Working number 6. I want to calculate X int price. You can see the way we abandon the calculation since we have to come and do all these workings. So that's what is expected of you. You must know what is next, what you should do next. So to get the X int price, so we are going to pick the current share price, sorry, the current market price of the debenture, which is the cum interest price. The cum interest price is 105.3. Okay. What's wrong with some? 105.3. Then you less the interest. Interest is 10%. And I told you always ignore the percentage because debt is always quoted at 100 naira per unit. When you do 10% of 100 naira, it will still give you the same 10. So just remove the percentage all the time. So here will be 10. So X int price is 95.3. Okay. So now that I've calculated the X int price, I can then go ahead and calculate the market value. So multiply by 95.3 divided by 100. So this will give us 200,000 naira multiplied by 0.953 equal 190,600. This is 190,600. Then we need to get the total market value. Total market value of equity plus preference plus debt. So this will give us 190,600 plus 34,000 plus 525,000 equal 749,600. 749,600. That represents the total market value. Okay. Yes, Timile, you talk to me.
Okay,
Timmy,
so yeah, so you lost me a bit on the X in price for the venture.
speak up. I can't hear you clearly.
Can you hear me? I said that you lost me a bit for the X in price for the debenture.
X int price.
Yes, so I'm a bit lost on how we got the 105.3.
Is then in the question. That's the market value of the debenture.
Okay. Okay,
According
sorry.
to the question, you are told that the company has also issued 200,000 naira of 10% debenture, which are redeemable at par in 2 years' time, okay, with a current market value of 105 naira 3 kobo. All right, so is then in the question, that 105 3 kobo represent the market price of the debenture. But because you are told in the question that debenture interest has not been paid, it means that the 105.3 is cum int price. So you don't use cum int price to calculate cost of capital. You need to convert it to X int price. And that's what we have just done. Is it clear, Timmy?
Yes, thank you.
All right. So we can then move on to calculate our cost of equity. Now we have done the working that we need. So I can then say the market value of equity, total market value of equity is 525,000. This is working number, I think that's working number 5. Let me confirm. Working number 4. Okay. Working 4. Then plus the growth rate of 9%, 0.09. So all of this multiplied by 100%. So cost of equity equal to, then I will carry my calculator. Yeah, 60,000 multiplied by 1.09 equal divided by 525,000 equal plus 0.09 equal multiplied by 100% equal, that's 21.45, approximately 21%, 21.45. So cost of equity is approximately 21%. So keep that one on one side. Move to the second one. In the capital structure, we have preference shares. So we need to calculate cost of preference share. So I need to ask myself, before I put pen to paper, I must ask, what kind of preference share is this one? Is it irredeemable preference share or redeemable preference share? So according to the question, I told you when I was explaining the concepts, preference share will be redeemable if and only if the redemption date or maturity date is given to you. For the preference share, we are not given the maturity date. Therefore, it is assumed to be irredeemable preference share. Yes, Minister of Finance, go ahead.
I got 12.46%.
12.
Yes, sir.
You did not have you did not have the growth rates. That's why.
The
You need to have
0.09. I
yes
did.
now. You did not. Do it again. You can't have 12%. So the formula for calculating cost of irredeemable preference share. Of course, we said cost of irredeemable preference share is the ratio of fixed dividend to XD share price. Now, before I move down to this one, let me write the formula down first. Fixed dividend to XD share price multiplied by 100/1. Preference share does not have growth. There's nothing like growth under preference share. Now, let me go back to the cost of equity. You know, I told you earlier that you can either use absolute value or you use par value to calculate your cost of equity or even cost of preference share, any one of them. You can decide to use absolute value or you use par value. Please. If examiner is not specific, always use power value. Power value is faster. All right. Say, for example, if I want to use power value to calculate the cost of equity, okay, let me use this small space. If I want to use power value to calculate cost of equity, this is what I would do. It's the same formula. So I will just go ahead and calculate dividend per share. So we have calculated dividend per share to be 12 kobo. All right, 12 kobo, which is 0.12. What's wrong with you? 0.12, then divided by XDIV share price. XDIV share price, we calculated 1 naira 5 kobo. Then plus the growth rate of 9%, 0.09. All of this multiplied by 100 over 1. So, sorry, I did not include 1.09 growth. I did not include growth here. Multiply by 1.09, then plus 0.09, all multiplied by 100 over 1. So we should have the same answer as approximately 21%. Let's confirm. 0.12 multiplied by 1.09 equal divided by XDIV share price of 1.05 equal, then plus the growth rate of 0.09 equal, that's 0.2145 multiplied by 100% equal 21.46. All right. So that's it. Approximately 21%. So whether you use power value or you use absolute value, you are expected to get the same answer. All right. So that's that. Now let's proceed with the cost of preference share. So sorry, I'm using K instead of KP. Okay. So the dividend, the preference dividend is 6 kobo. That's the nominal rate. 6 kobo, 0.06 divided by XDIV share price we calculated is 0.34 multiplied by 100 over 1. So 6 divided by 34, what do we have? 6 divided by 34 multiplied by 100. That's 17.65. Here is 17.65%, approximately 18%. So cost of irredeemable preference share is approximately 18%. All right. So again, if I want to use, let's say, for example, I want to use total value. I want to use total value to calculate my cost of irredeemable preference share. Instead of using power value, I can then say KP equal to my fixed dividend will then be 6% multiplied by the nominal value of 100,000 naira. Okay, divided by XDIV share price. The XDIV share price is 34 kobo. 0.34 multiplied by 100,000. Because nominal value is 100,000. So all multiplied by 100 over 1. So it will still be the same thing. My KP will then be equal to 6,000 naira divided by 34,000 naira, all multiplied by 100 over 1. So KP will still remain approximately as 18%. Again, like I said, the power value is always faster. So use power value instead of absolute value, except if an examiner asks you to use absolute value, which in real case, examiner do say that. All right then, so the third step is to calculate cost of debenture. Number 3, calculating cost of what kind of debenture is this one? Is it redeemable or irredeemable? You are the one that will be asking the question. Of course, you are expected to go into the question and identify whether it is redeemable or irredeemable debt. So you can see in this question, examiner was even specific, telling you 10% debenture, which are redeemable at par in 2 years' time. Because, like I said, debenture or debt will be redeemable if the redemption dates or maturity dates are given to you. So in this question, you are told that this debenture will be redeemed at par in 2 years' time. 2 years' time is the redemption date. Therefore, it is redeemable debenture. So calculating cost of redeemable debenture, KD. Now, I told you that when you're calculating, whenever you want to calculate cost of redeemable debts, what do? Just go ahead and calculate internal rate of return. It's as simple as that. Even if you want to calculate cost of redeemable preference share, go ahead, calculate internal rate of return. So when you're calculating internal rate of return, what are you expected to do? You assume two discount rates that will produce two opposing NPV. One discount rate will give you positive NPV, another discount rate will give you a negative NPV. Then you interpolate into the IRR formula. That's what we want to do. So assume, and I told you, whenever you want to calculate your internal rate of return, always start with 10%, because if 10% gives you a positive NPV, you can increase to 15%. The essence of that is to minimize your iteration. All right, so let's assume 10%. Create a column for year, description of items, cash flow, discount factor, then present value. All right. So starting from year zero, we have current market value of the debenture. Then debenture interest will be paid for the next 2 years. So year 1 to 2, fixed interest. Then in the final year, which is year 2, this debenture will be redeemed. How are we going to redeem the debenture? Examiner say at par. Okay, so the cash flow, the X-int price that we calculated for the debenture is 95.3. 95.3 based on our working. That's working number 6, I think. Yes, working number 6. That's 95.3 X-int price. You don't use cum-int price to calculate that. It has to be X-int price. Okay. So the fixed interest, the interest is 10%. Pay attention to what I'm about to say. Interest is 10%. You are going to go and calculate. You can't just put 10 there. You cannot put 10 here. It has to be after tax interest. So if you are given tax rate in the question, you must adjust for tax. But if tax is not given, in this question, let's say, for example, tax is not given, I'm going to put 10 here, just the way you have it. But we are given tax, so I cannot use 10. I have to go and calculate post-tax or after-tax interest. So let's go and do that. Okay. Working number 7. Post-tax interest. So post-tax interest is interest multiplied by 1 minus tax. The interest rate given to us is 10%. So just put 10, forget about the percentage. Tax rate given is it 30 or 40% tax?
40%.
40% tax. Payable 1 year in arrears. So 1.040. This will give us a 6. All right. That will give us 6. Our after-tax interest is 6 naira. Okay, so I can then come in and say here is 6. Now, pay attention. Pay attention. Okay, let me leave that one first. I will come back to it. I purposely put year 1 to 2. I want to test them. I want to explain something. That's what I do that. Then year 2, this debenture will be redeemed at par. At par means at 100 naira. So the next thing we need to do is to determine the discount factor and annuity factor. Okay. All right. NPV. Now, look up. Pay attention to what I'm about to say. Now, here is 10%. Discount factor for year 0 at 10% is 1. 1 multiplied by 95.3 will give us 95.3. Now, when you look at the interest, the fixed interest of 6 naira, you need to go back to the question. Examiner has told you that the company tax rate is 40%, payable 1 year in arrears. You have to pay attention whenever you are solving this kind of a question and you are given tax rates. You don't just assume that tax will be paid in the current year. So examiner has told you that tax is paid 1 year in arrears, meaning that there's 1 year lag. So what I mean is that you are not, when you are calculating your annuity factor, you cannot do for year 1 to 2 because tax is paid in arrears. So the interest that the company is supposed to pay in year 1 will be paid in year 2. The interest of year 2 will be paid in year 3 because there is 1 year lag. Therefore, I cannot do year 1 to 2. It has to be year 2 to 3 because of tax impact. So had it been the examiner is silent, you are not told whether interest is paid in arrears or in current year, examiner is silent, then you are at liberty to assume tax is paid in the current year. But once you are told that tax is paid 1 year in arrears, then you have to give 1 year lag, meaning that instead of you to start from year 1, you start from year 2, then it will extend by 1 year because of tax impact. Yes, Yusuf, Sanusi, talk to me. Yusuf, go ahead. You raise hand.
Good evening, sir.
Good evening.
Yes, sir. Sorry, I just needed you to re-explain that aspect of tax. If the tax is in the area, sir. That's very sure.
I said, if in a question you are told that tax is paid in arrears, meaning there's 1 year lag. If you make profits in say for example now, profit of 2002, which of course mostly around the world, tax is usually paid in arrears, even in Nigeria. Meaning that the profits that a company earns in 2024, for example, the tax will be paid in the following year, which is 2025. The profit of 2022 will be taxed in 2023. There's always 1 year lag. All right. So meaning that, like in this case now, examiner told you that interest is payable, tax is payable 1 year in arrears. So because of tax implication, the interest that the company is supposed to pay in the first year will move to the second year because of that tax impact. The one of second year will be paid in third year. That's why you are seeing year 2 to 3 instead of year 1 to 2. There's 1 year lag. So in this case, the way you are going to calculate annuity factor of year 2 to 3, there's no formula for annuity factor of in between years. So there's a way you are going to do it. I will demonstrate that for you now. So Sanusi, Yusuf, is it clear now?
Perfect, sir. Thank you, sir.
All right then. So let's go and calculate annuity factor of year 2 to 3 at 10%. Working number 8. Annuity factor. AF. And you know that annuity factor is calculated as 1 minus 1 plus R raised to power minus N, all divided by R. Of course, R is the discount rate, N is the number of years. So at 10%, we're assuming 10%. Now, whenever you want to calculate annuity factor in between years, like I said, there's no formula to do that. Like in this case, we want to calculate the annuity factor between the second and the third year. Okay, so what are you supposed to do? Simple. You need to calculate annuity factor from year 1 to 3, then you deduct discount factor of year 1 from it. Whatever you have is the annuity factor between from year 2 to 3. So this is what I'm saying. Yes, I will say years 1 to 3. The annuity factor will be 1 minus 1 point. We're assuming 10% at 10%. Okay, 1.10 raised to power n is 3 raised to power 3 because we are doing year 1 to 3. Then divided by the discount rate of 10%, 0.10. Okay, so what do you have here?
2.486.
What did you say it is?
2.487.
Okay, 2.487. That's the annuity factor of year 1 to 3. So I need to calculate discount factor. Discount factor for year 1 at 10% for year 1. So discount factor, as you know, discount factor equal to 1 plus R raised to power minus N. Let me write that. Okay. Raised to power minus N. So in this case, the discount factor would then be equal to 1.10 raised to power minus 1 at 10%. Of course, this is equal to 0.909. So find the difference. So this will then give us this annuity factor. This is annuity factor of years 2 to 3. Years 2 to 3. That's it. So what's the difference? 2.487, 2.487 minus 0.09, 0.09.
1.578.
Thank you, 1.578. So that is at 10%. So let's go up there and put it down. Here is 1.578. Then discount factor at 10% for year 2, 0.826. So multiply 6 multiplied by 1.578 multiplied by 6. That's 99.468. All right, that's a 9.5 approximately. Then 100 multiplied by 0.826, that's 82.6. So 82.6, 82.6 plus 9.5. Oh, sorry, error. 82.6 plus 9.5 equal 92.1, then minus 95.3, minus 3.2, minus 3.2. So we assume 10%. We got a negative NPV of 3.2. We need to assume a lower discount rate that will produce a positive NPV. So let's assume 5%. Okay. So we need to go and calculate annuity factor of year 2 to 3 at 5%. So at 5%. All right. So here will be 1 minus 1.05 raised to power minus 3 equal, then divided by 0.05. So what do you have there?
2.723.
2.723. Then discount factor for year 1 at 5% will give us 1.05, okay, raised to power minus 1. Okay.
0.952.
952 minus 2.723. That's
1.777.
1.771. Okay. 1.771. That's it. That's how to calculate annuity factor in between years. So here is 1.771. Then here is 0.952. I know this one to be negative 5.2. Then what's the present value? 6 multiplied by 1.771.
10.626.
10.62. So that's 10.6. Here is 95. Let me write it. 95.2. So 10.6. 10.6 plus 95.2 equal, then minus 95.3 equal net. Oh, what's this?
Positive 10.5.
Positive 10.5. Okay. Here is
Correct.
10.5. So now that we have two opposing NPV, we can then proceed to calculate cost of redeemable debenture. So KD equal to lower discount rate plus net present value of the lower divided by net present value of the lower plus net present value of the higher discount rate. Higher discount rates minus lower discount rates. Okay, so cost of redeemable debenture, 10% is lower, 5% is lower than 10%. So 5 plus NPV of the 5 is 10.5. 10.5 plus NPV of the higher, 3.2. Higher discount rates of 10 minus lower discount rate of 5. Yes, somebody is chatting me. Your screen is not on. Olamide, what do you mean by that? You mean you cannot see my screen, Olamide?
Good evening, sir. Yes,
You
sir.
say you can't see my
On,
screen?
sir. Yes, sir. Yes, sir. But it's on now, sir. It's okay now. I can see it now, sir. Yes, sir.
Okay. So KD, I want to list space for WACC. So KD, let me manage it, equal to, so I would then say 10.5 plus 3. If you have the finger hands, you can quickly give me without stressing me.
8.8.
8.882.
Pardon?
8.8.
8.882.
8.832.
32.
Oh, okay, 8.83. So the cost of redeemable debenture is approximately 9%. Okay, this is approximately 9%. So that's that. Then step 4 is to calculate WACC. Calculating weighted average cost of capital, KW. Therefore, WACC is equal to equity value divided by equity plus preference plus debt, because we have the three of them, multiplied by cost of equity plus market value of preference share divided by value equity value plus value of preference share plus debt value multiplied by cost of preference share plus debt value divided by equity plus preference plus debt. Okay, multiplied by after tax cost of debt. Okay, therefore, WACC will be equal to equity value. We got 525,000 naira. The total market value of equity, preference, and debt, we got 749. Is it 749,600? Let me confirm. Working number 5. 749,600. Yes, that's working number 4. 749,600. Then multiply by cost of equity 21% we calculated, plus market value of preference share 34,000 divided by total value 749,600 multiplied by cost of preference share, we got 18%, plus value of the debenture, we got 190,600 divided by total value of 749,600. After tax cost of debt, we got approximately 9%. So we've already adjusted for tax. There is no need for you to come and say 1 minus tax again. When you do that, that means you are double dipping. So you don't need to come and say 1 minus tax. We've already deducted for tax. We've already adjusted for tax, rather. All right. Okay. So give me from the left. What do you have? 525 divided by 749,600 multiplied by 21. Forget about the percentage.
14.71.
14.71% plus from the middle.
0.87.
0.87% from the from the right.
It's 81 or 87. It's 0.81.
817. 0.817, sir.
8
Okay,
82.
Yes, sir.
Okay, 0.82. All right. From the right.
2.29.
2.33. 2.300. 300. Just 3.3.
No.
2.30.
2.29, sir. 2.29.
Okay, that's 2.3. All right.
Exactly,
So
2.3.
add the three of them together. What do you have? That is
17.82.
17.82%. 17.82%. So the WACC is approximately 18%. So that is how to calculate weighted average cost of capital. The essence of choosing this question is to demonstrate for you how to calculate annuity factor in between years. All right. It can come in any form. You can have it under capital investment decision. You can have it under APV. It can happen anywhere, but you must know how to estimate annuity factor in between years. All right. Okay. Yes, that is that. Let me know if you have any question on this so that we can move to project specific. Time is far spent. We spend over 1 hour on this small, on this same question. All right. So if there is no other question, then let's go to project specific. At least if I cannot do calculation today on project specific, I should be able to explain the concepts. All right. So let me see. Let me just use this material and do that. Project specific. Cost of capital. Now, when we started this topic, I told you that WACC can be grouped into three or can be categorized into three. We have traditional WACC, we have project specific WACC, and we also have WACOCA. Now, we just concluded traditional WACC. So let's move to project specific WACC. I told you when we started traditional WACC, I said that traditional WACC is computed when information on capital structure, including their underlying costs, are given to you. When you have ordinary share capital, preference share capital, debt capital, including their underlying costs like dividend, share price, dividend, interest, and all of that. So that is when you use, that is when you calculate traditional WACC. But for project specific, it's a different ball game. There's something you must look out for in the question that will enable you to know this is, I'm supposed to calculate with, project specific WACC. So let's take it one by one. Let me just do the writing for you. Now, project specific cost of capital. This is computed. Let's put it down. This is computed. This is computed when a company is diversifying. When a company is diversifying, let me show this one up. When a company is diversifying, or when debts, or when, I said when the company is diversifying, or when the systematic business and financial risk of a company is expected to change. Is expected to change as a result of undertaking a project. As a result of undertaking a project. All right. So if the key point here is that the key point is diversifying. All right. Examiner will surely tell you. If examiner did not mention diversifying, you may be told that, oh, company XYZ operating in operating in a communication is contemplating on embarking projects in example. We just give you another industry different from the existing one. So once you can identify from the question that the company is diversifying, then you need nobody to tell you that you are supposed to calculate project specific WACC. Let me rewrite it. Diversifying. All right. So once there is indication in the question that the company is diversifying, then you need, and you have to calculate cost of capital. That means you are supposed to calculate project specific cost of capital. So let's buttress the points. Okay.
Yes, sir.
Now, in this case, when the company moves to a new industry and there is need for the company to undertake a project, of course, the existing WACC will not be suitable to appraise the new project. Therefore, a cost of capital that will be consistent with the risk associated with the project will need to be estimated. So let me put it down for you. When a company is diversifying, when a company is diversifying, the existing WACC may not be suitable or appropriate, to appraise, to evaluate, to appraise projects in the new industry. Therefore, a cost of capital that will be consistent, or a cost of capital that is consistent with the systematic risk, with the systematic business and financial risk that is consistent with, let me write this, that is consistent with
I look for changes also.
the project risk.
My brother,
Whose dog is
upload.
barking there?
Oh, yeah.
Nkechi, please mute. Nkechi, mute. Thank you. So, like I said, therefore, a cost of capital that is consistent with the project's risk should be computed, should be estimated. So that cost of capital is the project-specific cost of capital. So that's just the introduction. So like I said, you calculate project-specific WACC if there's indication in the company, in the question that the company is diversifying, or you are told that the debt equity proportion is likely to change as a result of undertaking a project, or business and systematic risk of the company is expected to change as a result of undertaking a project. So when this happens, the project-specific cost of capital should be estimated. All right. So this is because the existing WACC of the company will not be suitable to appraise a project in the new industry. So that's why you need to estimate a cost of capital that will be appropriate or that will be consistent with the risk associated with the project. Every project may be affected with both business and financial risk. All right. So there are some terminologies you need to get familiar with as far as project-specific cost of capital is concerned. So let me put it down for you. Terminology. What are those? Number one, you must know what is business risk. Examiner can ask you, in recent time, there was a particular question where examiner asked you to explain business risk, uh, financial risk. I think there was a time you also asked to students to explain asset beta and then equity beta. So you must know all of this. Financial risk. Number three, you must know about proxy company. Proxy company. Number four, you must know about beta. Okay, so let's talk about each of them. What do you mean by business risk? Okay, so this is the risk arising, or this is the risk. This is the risk associated with the industry where a company operates. With the industry where a company operates. All right. So in a question, examiner will not ask you to calculate business risk. It's implied. You know, we talk about project specific, that a company is moving from one industry to another industry. So that means a company is diversifying. So when you want to measure the risk associated with the industry where the company is diversifying to, you need to calculate business risk. And business risk is measured by asset beta. Okay, so business risk is measured by asset beta. Okay, so that's, for simplicity, that's what you should know about business risk. Let's talk about financial risk. So what do you mean by financial risk? This is the risk arising from debt financing. When a company finances its operation with debt capital, then the company may be exposed to financial risk. All right? This is the risk arising from debt financing. This is the risk arising from debt financing. So when a company finances its operations with debts, such company may be exposed to financial risk. So when a company has debt in its capital structure, for example, debt like bonds, debenture, loan notes, or bank loan, then there is likelihood that the company may be exposed to financial risk. So financial risk is measured by equity beta. The financial risk is measured by equity beta. Okay, then let's talk about proxy company. Proxy company. All right. Proxy company. What do you mean by proxy company? Proxy company is a comparable company that operates in the industry where a company is moving to. Of course, generally, it is assumed that both the proxy company and the main company have similar business risk. So let's put it down. Proxy company, this is a comparable company. This is a comparable company that operates in the industry where the main company is moving to. Where the main company is moving to. Okay? It's assumed that both the proxy company and the main company. The main company is the company that is moving. Have similar business risk. That's why you want to borrow the beta of the proxy company. So, of course, in reality, in practice, there is no company that is similar in size, even in operation, in management structure. No company is identical. But in theory, we can say just an assumption that the company have similar business traits. It's not possible because every company's management structure differ. Company XYZ, the management structure of company XYZ in practice will certainly be different from the management structure of company ABC. It's not the same thing. So the risk associated with each of the business with each company differ. So it's just a theory. It's just theoretical to say that two businesses are identical. So in terms of size and structure, they are not in practice. All right. So for example, now, when you talk about proxy company, if, for example, company where like equity professional is into education business, let's say equity wants to diversify into oil and gas. The risk associated with education business is different from the risk associated with oil and gas. So if equity professional wants to execute a project in the oil and gas industry, then there will be need. The existing WACC of equity professional that we normally use for appraising projects under education business cannot be used to execute or to evaluate a project in the oil and gas business. Therefore, equity professional will need to meet with the companies that are already operating in the oil and gas to borrow their beta for the purpose of estimating cost of capital that will be suitable to evaluate projects for that will be suitable for equity professional to evaluate projects in the oil and gas. So those companies that are already operating in the oil and gas are what we call comparable companies or proxy companies. All right. They are comparable companies that operates in the industry where a company is moving to. All right. So that is what proxy company is all about. Okay. Just like you now, if you are just joining a class, there are some students that already that have registered before you. Say, for example, you are just coming. When you come in, you can't just sit down and you want to join the class. You need to ask, please, is there any material for this class? What are the notes that have been shared before? So you are asking because you are new. So you need to cool down, observe things before you begin to behave like the like the real how do I put it? Like the real people, you know. So it will take time for you to blend to blend with the people that are already operating in the industry. So that's what I'm trying to say. Now, number last is beta. Let's talk about beta. Okay. Beta. What do you mean by beta? Beta measures both business and financial risk. Okay. This measures systematic business and financial risk. Okay. Beta is a measurement of risk. Basically, there are two types of beta. Basically, there are two types of beta, including one, asset beta, denoted as BA, then two, equity beta. Okay, so let's explain each of them. What do you mean by asset beta? Okay, this measures only business risk. This measures only business risk. So whenever you want to measure the risk associated with we said that when you want to measure the risk associated with the industry where a company operates, that is business risk. So to measure that risk, of course, you need asset beta. So that's what I told you here. Business risk is measured by asset beta. All right. So yes, that's basically what asset beta is all about. You use it to measure business risk. I will show you the formula you are going to use later on. Then equity beta. Equity beta. This measures both business and financial risk. When a company is only financed with equity, then equity beta is the same as asset beta. When a company is only financed with equity, equity beta, equity and asset beta are the same or will be the same. So that's that. Okay. So these are the some terminologies that we are going to be using as we proceed under project specific, and you must know each of them. In case examiner asks you to explain asset beta, equity beta, so these are the things you are going to talk about. All right, it's something straightforward. Now, finally, under project specific, let me demonstrate. Let me show you the procedures you are supposed to carry out whenever you want to calculate project-specific WACC. All right? Steps involved. In calculating project-specific cost of capital. So basically, there are 5 procedures that needs to be carried out. There are 5 procedures to be carried out whenever you want to calculate project-specific cost of capital. Step 1 is to identify. Let me write that. Identify proxy beta. Now, how do you identify proxy beta? You go to the question. Whenever examiner gives you a scenario and you're asked to calculate cost of capital, usually from the first paragraph, there will be an indication to show you whether this is project specific. Once you can see from the paragraph, on the first paragraph, once you can see that the company intends to diversify or the company is diversifying, then you need nobody to tell you that, okay, this is project specific. Now, you have identified from the question that you want to calculate project specific. Then you also need to identify the first step to calculate your project specific is to identify the proxy beta. Now, examiner will give you the name of the company that wants to evaluate projects. Now, another name will also be given in the question. That second name represents the proxy company. All right. The second name given in the question represents the proxy company. But if examiner did not mention the name of the proxy, you are going to be told, you are going to be given the information about the proxy company. So just go to the section of the question where you have information on the proxy company. Then from there, you will see beta that will be given to you. So once you have found the beta, that means you have identified the beta. So keep it on one side. Then step 2. The step 2 you are going to carry out is to ungear the beta if it is geared. So ungear the beta in step 1 if geared. All right. So if the beta in step 1 is geared, so you need to ungear it. So how do you ungear? Let me show you. How do you know that the beta is geared? So let me write that. If geared. So, like I said, how will you know that the beta is geared? The beta will be geared. Okay, let me put it down. The beta will be geared if the company finances its operation with debt capital. If the proxy company finances its operation with debts, e.g., when in the question you can see bonds, debentures, loan notes, or bank loan, then of course it means that the proxy company is a geared company. All right. So that's how to know whether the beta you have identified in step 1 is geared. Once you go to the question, go and check the capital structure or you go and check the balance sheet of the proxy company. If you can see any form of debt like a bonds, debenture, loan note, or bank loan, so it means that the beta you have identified in step 1 is a gear beta. Therefore, how do you then ungear? So ungear beta simply means asset beta. All right. Let me even put it here. Asset beta, where you have. So asset beta is also known as ungear beta. Let me put it here. This is also known as ungeared beta. That's asset beta. Okay. So, like I said, how do you then ungear? To ungear the beta, the formula below can be used. Okay. Now, can be used depending on whether or not debt beta is given. Okay. So, number A, where debt beta is risk-free. Where debt beta is risk-free. Okay, that is equal to 0. So according to Miller and Modigliani, the two guys said that debt beta is always risk-free. All right, but that's not the case in practice. But we're assuming that in this instance, debt beta is assumed to be risk-free. So if that happens, then the formula to use to ungear will then be equal to, so your the asset beta will then be equal to beta equity of a gear multiplied by equity value divided by equity value plus debt value 1 minus tax. So this is the formula you are supposed to use to ungear where debt beta is risk-free. E is equity value, D is debt value, T is company tax rates. Of course, this represents the tax rate of the proxy company. All right. Alternatively, where debt beta is given, then you are going to use extended formula. Where debt beta is given, then you are going to use this big for nothing formula. So here will be beta assets equal to beta equity of a gear company multiplied by equity value divided by equity value plus debt value 1 minus tax rates of the proxy company plus debt beta multiplied by debt value multiplied by 1 minus tax divided by equity value plus debt value 1 minus tax. All right, so this is the formula you are going to use to ungear to calculate asset beta where debt beta is given to you. All right, so the formula you are going to use to ungear will depend on whether debt beta is risk-free or debt beta is given. All right, so now note the information of the proxy company should be used in step 1 and 2. The information of the proxy company should be including the information of the proxy company, including equity value, debt value, tax rates, and debt beta, and debt beta, and debt beta should be used. Okay, so this is very important so that you don't give what belongs to Peter to Paul. So that you are not using the information of the main company. From this step 1 and step 2, you need the information of the proxy company. You need the information of the proxy company. All right then. So let's move to step 3. Step 3 is to regear. Regear to incorporate financial risk. To incorporate the financial risk. Okay. Of the main company, the financial risk of the main company. Like I said, the main company is the company that is diversifying. So that's step 3. How do you then regear? How do you regear? The formula below. I've told you, you can't do much in SFM if you cannot memorize formula. That's why SFM is unique from other, relative to other subjects. That's why students are saying SFM is different. It's not difficult. It's just because of the formula. Once you are able to master formula, you are good to go. All right. So the formula below can be used to ungear depending on whether debt beta is given or not. Can be used to ungear depending on whether or not debt beta is given. Okay. So if I don't want to, for example, if I don't want to use this other formula, this one, I can say, let me put it down, or beta assets equal to beta equity of a gear multiplied by 1 divided by 1 plus 1 minus tax multiplied by debt equity proportion. All right, so I can also use this formula. I will get the same answer. If you have the golden book, you will see all of these different formulas there. Yes, Timileyin, talk to me. Timileyin, you raise hand.
Yeah, I don't know if you said to incorporate the financial risk of the main company using the formula to gear, but I thought we were trying to regear regear forward what we do before.
I don't
So
understand your question.
number 3 is regear, right? And you're saying that we're trying to ungear, so I'm a bit lost there. I don't know.
I say you are going to ungear. Or can be used to, to gear, I wanted to say thank you. I wanted to say to regear, can be used to regear. It's a slip of tongue. I said that to incorporate the financial risk of the main company, the formula below can be used. Let me remove this column. The formula below can be used to regear, depending, I wanted to say regear, not, thank you. Okay, so where debt beta is risk-free. So where debt beta is risk-free and you want to regear, then beta equity of a gear will be computed as beta assets multiplied by 1 plus 1 minus tax, okay, debt equity proportion of the main company. So you use this formula to regear when debt beta is assumed to be risk-free. Number B, where debt beta is given, where debt beta is given, then in this case, just repeat the formula you have in step 2. Repeat the same formula you have here. Okay? So here will then be equal to beta assets. Beta asset will be equal to beta equity of a gear. You want to make, of course, BEG will then be the subject of the formula because you must have calculated the BA in step 2. All right. So you use the known variable to get the unknown. Then multiply by equity value divided by equity plus debt, 1 minus tax of the main company, plus the debt beta of the main company multiplied by debt value into 1 minus tax divided by equity plus debt value of the main company, 1 minus tax. So that is the formula you are expected to use to regear. All right, you are expected to use to regear where debt beta is given to you. All right. So, of course, from step 3 to step 5, you need the information of the main company. Let me put it down for you. Notes. To regear, the information relating to equity value, debt value, tax rates, and debt value, debt beta of the main company should be used so that you don't give one belongs to Peter to Paul. So at times the debt value will not, in most cases the debt value may not be given to you, may be the one that will calculate the debt value and the equity value the same way we calculated equity value and debt value under traditional WACC. It's the same thing. You go and calculate market value of equity, market value of debt. So that will form the debt equity ratio or debt equity proportion of the company. All right. So yeah. Then we move to step 3. Now, if in the question you are given debt beta of the proxy company, but you are not given debt beta of the main company, then you are at a liberty to assume that debt beta is risk-free, or you assume the debt beta of the proxy company. But again, always assume that if you are not given the debt beta of the main company, always assume that it is risk-free. You don't need to be stressing yourself. All right. So let me add one more. Let me put it down for you. If the debt beta of the main company is not given, is not given, we can either assume it is risk-free or assume the debt beta of the proxy company. So whichever one that is convenient for you. Again, always assume that once you are not given, you don't need to stress yourself. Just assume that it is not given. So you ignore it. It's risk-free. So that's as per that. Then step number 4. Step number 4, calculate cost of equity. Step 4, calculate what's wrong with you? Calculate cost of equity using capital asset pricing model. Calculate cost of equity using capital asset pricing model. For this purpose, capping is calculated as risk-free rate of return plus beta into market return minus risk-free rate of return. So this is the formula for calculating cost of equity using capital asset pricing model. So I will explain the variable shortly. Then finally, step 5, estimate WACC. Estimate WACC. KW. So WACC is equal to, of course, under project specific, it is assumed that the company is financed with both equity and debt, nothing like preference share. So here will be equity value divided by equity plus debt multiplied by cost of equity plus debt value, equity plus debt, cost of debt, 1 minus tax. So that's that. These are the 5 procedures you need whenever you want to calculate project-specific cost of capital. We said the first step is to identify proxy beta. Step 2, you ungear. Step 3, you regear. Step 4, you cap it. Then step 5, you WACC it. So that will give you the 5 procedures that you need to calculate project-specific cost of capital. If you want to put it in acronyms, all right. So the acronyms will be proxy beta, ungear, regear, cap it, then you WACC it. So those are the 5. Identify proxy beta, ungear the beta, regear the beta, calculate capital asset pricing model, then you calculate WACC. So that's it. That's it. So yes, let me know if you have any question for me. We have about 15 minutes more. That will not be sufficient to solve a question. That will not be sufficient. So I don't want to start what we are not going to finish. All right. So yes, Timile, you talk to me.
Mr. Can I see step 4?
Step 4, okay.
Thank
Yeah,
you.
that was also my question. Step 4 and 5. I lost you a bit there, so I just want you
Oh,
to just cover that.
okay. So I said in step 4, you are expected to calculate cost of equity using capital asset pricing model. You know, I told you when we started cost of capital that there are 3 methods of calculating cost of equity. 1 is dividend valuation model, 2, capital asset pricing model, then 3, Miller and Modigliani. So the capital asset pricing model formula to calculate cost of equity is what you have here. All right. So yes. So after that, of course, the final step is to calculate WACC. You're already familiar with the formula for calculating WACC. So that's that. So let me just explain the variables once and for all, where we started from on gear. Under the on gear, we have BA. Let me explain what is BA. Where BA equal to asset beta. BEG equal to beta equity of a gear company, of a geared company. Then we have E, which is equal to equity value. Then we have D equal to debt value. We have T equal to company tax rates. Company tax rates. What else? From the formula, we also have BD. BD simply means debt beta. BD equal to debt beta. Then, of course, we have KE. You know KE already to be cost of equity. Then you have risk-free rate of return, RF, which is risk-free rates of return. Then we have RM. RM, let me put before RM, beta. Okay. Beta value. Then we have RM, which is equal to market return. Then the difference between market return and the risk-free rate of return is called market risk premium. Okay, so these are the letters that we have used so far, and I've explained them. Let me see if there's any other one I'm missing. I think that's it. That's it.
Hello, sir.
Yes, who is talking to me?
Sir, please, the beta, is it beta, asset beta or equity beta?
Which one?
The beta, the beta value.
Yes, it's the beta you have in step 3 that you are going to use. That beta in step 3 where you re-gear.
Okay.
Yeah.
So it's equity beta.
Pardon?
So, sir, it's equity beta.
Yes, yes.
Thank you.
It's a gear beta, yeah. Okay. So let me know if you have any question for me. This is where we are going to call it a day. In our next class, by the grace of God, we are going to complete this topic, which is cost of capital. And next week will be the 6th class on cost of capital. So once I'm able to complete a question on this, then we are going to talk about weighted average cost of capital of the combined activities, which is the WACC. And after that, that will be end of cost of capital. So we can move to a brand new topic. All right. So in the absence of no further question, I want to say good night to every one of you. Thanks for your patience.
Thank you very much, sir.
You're welcome.
Thank you, sir.
You're welcome.
Good night, sir.
Good night.